Good morning. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. And to kick off the trading week, I have Evan Bauman. He's a portfolio manager at Clearbridge Investments joining me at MarketSite. Evan, I want to thank you for joining me here today.
Good to
so
see you.
You manage the Aggressive Growth Strategy Fund, CACG.
Yep.
My question to you is, what are the challenges that comes when you're managing an aggressive portfolio?
Well, so we invest for decades. Actually, in a lot of cases, we've owned companies not for months or years, but actually multiple decades. So in this world that's very short-term oriented and short-term performance focused, we're trying to find great businesses that we can hold for long periods of time. And I think the other big challenge is we're contrarians. So we're trying to buy growth companies on the cheap, and the market recently has been very momentum oriented. So while returns have been okay, I think we're trying to find companies that can continue to grow earnings, continue to grow cash flows, worry less about the quarter to quarter and more about the compounding of earnings and cash flows over long periods of time. And we manage with a very high active share kind of strategy. We have some big overweights in certain areas and some big underweights. And again, just trying to find really misvalued growth companies regardless of what the benchmarks are positioned looking like.
Well, let's talk about that. What is your longer term economic and market outlook? Can we go on for the 9th year of a bull run? It's been 8 years in the running.
The interesting part is we're 9 years in and people are really not bullish just yet. So they're bullish on certain parts of the market. I would argue there are some complacent sectors and subsectors. There are some pretty overvalued parts of the market, but for a market that's this far into a bull run, you have a lot of skepticism, and that's a good thing. There's also a lot of undervaluation in certain parts of the market, but I don't feel it's as easy as just owning the market anymore as maybe it was a year and a half ago even, or certainly back in 2011 or 2009. I think stock selection and sector selection are really a lot more important right now. But again, the interesting part is outside of a few stocks and a few subsectors, people are still very negative on everything, and that probably means that on a longer term basis, there's plenty of room to go for the market itself.
So where do you see a specific opportunity, for example? What sector do you love the most?
So I think the overweights, and so you could say what we really like are the areas that we overweight are healthcare, energy, and then parts of media, parts of technology. We don't have a big overweight to the big stuff in tech, but there's plenty of areas within information technology like storage and connectivity chip companies, certain software companies where the risk reward is really favorable. Healthcare, you could argue, particularly the big therapeutics companies in healthcare, like biotech, has basically been in a bear market for the last couple of years, even though it's rallied recently. A lot of stocks are still well off their highs, and valuations in healthcare are way off their highs. I mean, the big guys trade at sub 15 times earnings right now, companies like Biogen and Amgen, versus a market that's close to 20. And energy, I think, is pretty close to a dartboard phase. You could probably throw a dart at a high quality, liquid, well-funded energy company right now, and I think you could do pretty well, because that's another sector that's had a rough run for the better part of 3 years, and especially in the last 6-7 months.
Well, it's going to be interesting when they start reporting for the second quarter, because they're comping against such bad numbers that...
Yeah, you wonder what's in the stocks.
Right.
I mean, you really wonder when you look at valuations in areas like energy and healthcare, I think expectations are really low. And for the big energy companies, I think it's less important what they report and what they guide in terms of capital spending and the opportunity to grow cash flows over a longer period of time. But like I said, versus some parts of the market where expectations are very high, think kind of mega cap tech and internet and some of those areas, there's some pretty low expectations in areas like biotech and energy and even some parts of the media space like programming companies. So there's stuff to like, and there's stuff that not necessarily is dramatically overvalued, but certainly where I think the big risk is really high expectations going into the quarter.
Right. Well, I know you have to deal with the 24/7 news cycle, which makes a longer term position a little bit trickier to manage, but what keeps you up at night?
Pretty much everything. I mean, I think that if we're going to do my puppy, I think that we're going to do well or poorly based on our company's abilities to execute. And if they do that, I can't control the short term. I can't control what the market does on a daily basis. And I think, again, if you're really benchmark agnostic, managing a very high active share portfolio, but getting compared to what the market is doing, the trickiest part for us as bottoms up high active share managers is worrying about the fundamentals. If we get the fundamentals right, over time the market's going to monetize that. And if the market doesn't, other companies will. And I think that's another interesting part about the market right now is balance sheets are in great shape. Companies have tons of capital, tons of liquidity. They have a lot of cash and access to cheap money. So there are sectors like healthcare where I wouldn't be shocked if you have a big consolidation wave over the next few years. Energy eventually, if assuming that oil prices stay in this sort of range or this channel they've been in, companies are going to figure out that it might be cheaper to acquire assets than go and drill for them. So I think there's a lot of good things happening under the surface. For us, again, to the question, what keeps us up? If the companies execute, we'll be okay. The key is obviously it's making sure we own the right companies for the environment we think we'll be in.
All right, and let's wrap it up. What are you hearing from investors?
Almost all investors right now are scared. They're scared about the macro. They worry about politics. I think in a lot of cases, politics are difficult to handicap. And so find companies that, regardless of the headlines, trade at cheap valuations with real potential for subtle catalysts that aren't yet in the valuations, that people aren't yet looking for. But investors are very negative on everything. And that's what's fascinating about that is the markets are up basically at all-time highs. And the S&P's had a very good year. I mean, it's up close to 10%. Nasdaq's up even more, yet it certainly doesn't feel like it. This does not feel like the 9th year of a bull run. This does not feel like the late 90s where people were bragging about how much money they were making. Everybody's worried about losing it. And so that's, I think, the most unique part of the market today is just how skeptical people are. Again, from a contrarian point of view, that's really good. Outside of a couple of sectors and subsectors that might be getting a little bit long in the tooth or frothy, I think there's still a lot of great opportunities. Again, it's just a matter right now, I think, of having an active portfolio that can seek out those opportunities, and where passive has done very well for the last couple of years. It feels to me like right now the opportunities are having a high active share, longer term portfolio that's a valuation conscious growth fund. So we feel good. When people are this negative, it's usually a good thing, and all we continue to do is try to hold on to investors and remind them why they're invested in the market for the long term.
All right, well, thank you very much, Evan, for joining me at MarketSite and Traders. As always, thank you. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.